Hello and very warm welcome to Victory IS. As you are aware that we are doing a series on 2 years current affair rapid revision. So let's proceed with the topics in Indian economy. As you can see, International Financial Services Center, as we have seen in Gift City, Gujarat as well. So the regulation mechanism, etc., that we need to discuss. Indian Finance Ministry has announced that courses in financial management, fintech, science, technology, engineering and mathematics, combinedly known as STEM, offered by foreign institutions in International Financial Services Center such as Gift City in Gujarat, will be exempt from certain provisions of the University Grant Commission and All India Council for Technical Education, that is AICTE, right? It will be out from the regulation mechanism of these regulators, right? The regulation will be the regulatory framework for these respective home country shall apply in all academic matters in such financial institution. Also, the regulatory authority for IFSCs, the IFSC authority will have limited jurisdiction over these courses, right? So a different authority, a separate authority for IFSC will be there, right? Now what is the aim for these kind of different regulatory mechanism that we need to understand? That this move aims to provide flexibility and encourage the participation of foreign institution in offering specialized courses in the financial and technology sectors with IFSCs, right? So about IFSCs, if we want to understand that IFSCs are designated areas within a country that facilitate the conduct of global financial services, right? For example, including technology in these financial transactions and in finances as well. They are designed to attract international financial institutions, banks and other financial services providers by offering a business friendly environment and a range of tax benefit as well, right? For example, tax exemption, for example, less taxation will be charged, these kind of things. It caters to outcome outside the jurisdiction of the domestic economy. For example, Dubai International Financial Center, DIFC, Gift City in Gujarat, Singapore International Commercial Code, that is SICC, and Shanghai International Financial Center, right? So this is about international financial. Now cross-border insolvency, as we have already seen Insolvency and Bankruptcy Code 2016, which helps in solving this insolvency issues in India. So cross-border insolvency, if we talk about, the Indian government has decided to halt its plan to adopt a cross-border insolvency regime that would have allowed foreign lenders to initiate bankruptcy proceeding against defaulting Indian businesses in local tribunals, right? So it is about a cross-border insolvency regime that would allow that would have allowed foreign lenders, right? If for example a business is there in India and the lenders are from foreign, then they can also have option for this insolvency, right? Insolvency proceedings. Cross-border insolvency typically occurs when a debtor has operations or creditors in multiple countries and there is a need of coordination. I have already explained you how this entire insolvency process is there. For example, there is committee of creditors, insolvency professionals are also involved. Insolvency professionals are preparing a resolution plan and that resolution plan has to be approved by 67% vote in committee of creditors. If it is not the case, then the firm may go for liquidation. That thing we have already seen. Cooperation among different courts and stakeholders achieve an efficient and fair resolution. When we talk about United Nations Commission on International Trade Law, that is UNCITRAL, that is UNCITRAL or UNCITRAL, like this also we can pronounce, or UNCITRAL also we can pronounce. Model law on cross-border insolvency 1997 is a widely accepted legal framework to deal with cross-border insolvency issues. So in India there is IBC, but at international level this model works, right? Model law, that is under United Nations Commission on International Trade Law. Why has India halted this plan? India halted the adoption of cross-border insolvency based on the fact that only around 50 countries have adopted the UN model, right, of cross-border insolvency, and many of them have stringent restriction in place. Instead, the government current priorities include: number one, expanding the informal debt resolution scheme for larger corporation, implementing a new regime of handling insolvency of group companies, and creating a special regime for the real estate sector, because real estate sector also faces lot of insolvency. Remove lacunas in the operation of insolvency and bankruptcy code, like government is reforming insolvency and bankruptcy code to a great extent. Reduce delays in case admission and approval of rescue plan. As we have already seen, approximately this filing in NCLT takes a lot of time, so that kind of reform can be taken undertaken by the government. Prevent inappropriate transaction by the management of defaulting companies. Now if we talk about insolvency, some terms here and there, keywords. If we talk about insolvency, is nothing but inability to repay outstanding debt. So if the debt is outstanding, the loan has matured, now you have to repay back, then then you are facing inability, that is insolvency. If we talk about insolvency and bankruptcy code, what is bankruptcy? Court declaration of insolvency is known as bankruptcy, with appropriate orders to resolve it and protect creditors' right. If we talk about insolvency and bankruptcy code, that is enacted in 2016, consolidated laws related to the insolvency resolution of business firm. If we talk about this amendment, insolvency and bankruptcy code amendment bill 2021, it introduces pre-packed insolvency resolution process for MSMEs, right, with default set up to 1 crore. Now it has been a very successful scheme with respect to insolvency in MSMEs. Now if we talk about challenges, then lack of proper resolution, with over 50% of cases ending in liquidation. So if it is going for liquidation, that means the resolution plan is not working. Significant delays in resolution, high haircuts means debt foregone. For example, the kind of preference that is there, if company is going for liquidation, then there is a kind of preference that is there. What kind of preference is there? For example, the first one to get the money will be the insolvency professional. So that kind of hierarchy is there, and finally the creditors get less amount than what they have given or what they have lent, right, by creditors. Lack of digitization of the process, these kind of things. Achievement, if we talk about successful revivals of India's revival of India's insolvency regime, and now recently insolvency and bankruptcy code was in news because of this Bhushan Steel, right, Bhushan Steel resolution plan. The IBC was in news because the case went to Supreme Court also, and Supreme Court also held the entire proceeding for 2 times, so that is why it was in news. Performing assets improved, credit discipline, India's rank in resolving insolvency improved significantly. Now if we talk about provision for cross-border insolvency, section 234 empowers the central government to enter into bilateral agreements, and 235 adjudicating authorities issue letter for request of foreign courts of IBC, right. 2016 provision is a basic framework for cross-border insolvency also. So the introduction of cross-border insolvency regime will consider once the institution capacity and overall bankruptcy resolution ecosystem are more robust. So as of now, these proceedings are halted, right. Now when we talk about US debt ceiling deal, now US government is facing crucial issue regarding the debt ceiling, right. So let's understand this debt ceiling, the maximum amount of money that the US government is legally allowed to borrow. For example, in India we have FRBM Act, right, Fiscal Responsibility and Budget Management Act. It is also there to limit the kind of loan that the government is taking, right. Now to fund the operations and meet its financial obligation, that is known as what? Fiscal deficit, right, when government is borrowing. So it is fiscal deficit also represents borrowing requirements of the government. Origin is established by the US Congress in 1917 during World War I to promote fiscal responsibility in the federal government. Now the issue is disagreement between President Joe Biden when he was the President of the United States, and the Republicans controlled US Congress, that is legislature, on raising the debt ceiling, right. Debt ceiling with the maximum amount that the government can borrow. The decision to increase the borrowing cap lies with the US Congress, which needs to vote in, right, legislature, part of legislature. Now the impact is possible default if the debt ceiling is not raised, then the government may default. Consequences such as weaker dollar, stock market problems, and job losses. Now if we talk about impact, the downgrade of US credit rating made future borrowings more expensive for the government. When credit rating agencies are giving low marks or low ratings, then the loan may become costlier. hinders discussion on long-term fiscal challenges and has been a political tool instead of a responsible fiscal mechanism. Now, if we talk about the impact on India, increased volatility in financial market affected currency exchange rate, capital flows and investor confidence. Impact on India's exports, since it is about external trade, foreign direct investment and overall economic stability. If we talk about previous instances of these nature, in 2011 the US faced a near default on public debt due to a delay in raising the debt ceiling. So they have revised it many a times. This led to the first downgrade in the US credit rating, a sharp drop in the stock market and higher borrowing cost. Now, suggestion for these reforms is automatic increase of debt limit, so that every time the POTUS or the executive need not go to the US Congress for this. Wherever legislation is passed or abolishing the debt limit altogether, right? You can abolish also, but that is a part of being a fiscally responsible government. India does not have a formal debt ceiling mechanism like the one in the United States, but we are having this Fiscal Responsibility Budget and Budget Management Act to take care of fiscal deficit. India's debt ceiling mechanism, if we talk about, the Indian government manages borrowing and debt obligation through fiscal discipline, budgetary controls and oversight by the RBI. The Fiscal Responsibility and Budget Management Act governs India's borrowing activities, setting targets for the fiscal deficit and debt to GDP ratio. I hope you are able to understand this. So this is where we will stop today, and we will meet in the next class. So stay tuned to Victory IAS YouTube channel to have more updates on the current affair. Thank you very much.